How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss in full detail life insurance retirement plans and how an individual could leverage a permanent life insurance policy, utilize the cash value to use as a retirement supplement or retirement plan in general, depending upon that individual situation. Please understand that when set up the wrong way, these things could be completely disastrous. So I want to show you the 30,000-foot view of how a permanent life insurance policy works, and then what we're trying to do to strip away all these different costs so that each dollar that you're placing in there is going more towards a cash value savings component of your policy, acts like a retirement account as opposed to going to a death benefit need. So this is different than traditional life insurance, or when when somebody wants to try to get set up in life insurance, they're looking primarily as a death benefit. And too often you have agents that go out there and they try to say, hey, we could set you up in a life insurance retirement plan and it's going to give you death benefit, it's going to give you long-term care, it's going to give you cash value, all this whole ball of wax, this whole, jack of all trades type product. And that's not the case. If you're looking to truly set up a life insurance retirement plan and leverage some of the tax-free benefits, you have to make sure that you're doing it the correct way and you're not falling victim to those easy traps, whether you're using a whole life insurance policy or an index universal life insurance policy. How to make sure that everything is set up properly and each dollar that you're placing in there is being maximized to the 10th degree. So for this video, I want things to look very neat, and I want you to really understand these concepts on how a regular permanent policy works, and then what we're doing to maximize out this cash value and have less go into the cost of insurance and other expenses. So usually what happens is when somebody sits down with a life insurance agent, the life insurance agent is going to tell them 10 million reasons why they want to maximize out this death benefit. They want to tell them, hey, you're making X amount of income, you have X amount in debt, you have X amount of a mortgage expense, of educational expenses, all these different things. Understand when you're trying to figure out your life insurance number, many times with the death benefit component of life insurance, that could be accomplished through term life insurance. So if your number comes out to $1 million, most likely you'll be able to accomplish your life insurance goal by using 700, 800,000 of term life insurance and a laddered strategy rather than purchasing a $1 million death benefit permanent life insurance policy. And the reason why I say that is because if you're purchasing that high of a death benefit, you're going to have very high cost of insurance and other expenses that are associated with that plan. So even though it sounds really good, yes, you're going to have a permanent death benefit sitting there regardless of whenever you pass away. If you're looking to leverage the cash value components, all those really good things about cash value and tax-free benefits regarding cash value, you want to make sure that that death benefit is as low as legal limits allow you to have it. So this is just a hypothetical example. But let's say that somebody says they're going to be putting in $1,000 into a life insurance policy, and the life insurance agent calculates for them that they need to have a permanent life insurance policy of $500,000 death benefit. But the main purpose of this individual is to set up a cash value maximization plan. So in this hypothetical example, what it typically looks like a policy is a little like egg-shaped circle. The $1,000 would go in, and there is a risk to the insurance company's books known as the net amount at risk. So that is the $500,000 that says if this person passes away, that insurance company is going to have $500,000 off of their books that have to get paid out to beneficiaries. So what that does is, because that's such a large difference between $1,000 of a premium payment and a $500,000 death benefit, you're going to have majority in that sort of situation, majority of your monies are going to the cost of insurance and other expenses. So that's going to be that larger red portion. Whatever does not go to that cost of insurance and other expenses, whatever does not suffice that net amount at risk to the insurance company, is going to get left over in a type of savings component known as cash value. So that's that little green part. And cash value is very interesting because, and it goes off of Internal Revenue Code 7702 and 72E, which states that cash value could be utilized as a tax-free benefit later on as a retirement supplement, as long as you're staying within legal limits that the Internal Revenue Code will allow. What happens is this cash value is going to be growing with any dollars that are being set up into this plan. Any dollars left over are going to be going into that cash value. So you're going to be netting whatever those expenses are is going to be going into that type of bucket. And then on top of it, there's certain interest credits that are tied to that, whether that's whole life insurance, it gets tied to to dividend payment that is associated to grow this cash value larger, or if it's index universal life, it'd be an upward market movement that anytime that the market goes up on a 1-year point to point, you would have a positive interest credit. Anytime the market goes down, you'll have a 0% rate of return. So that's ultimately how this cash value works. When it comes time for retirement, you could utilize this cash values based upon these rules as a tax-free benefit or as a retirement supplement. But if you're looking at this policy, you're saying, well, majority of this is going into the red. Majority of my $1,000 is going into that red portion, and yes, a very small portion is going to the cash value. That doesn't make a lot of sense. It doesn't mean that I'm going to have, if my main goal was to have cash value maximization, it looks like a lot of my monies are going to that cost of insurance. So what we try to do is what typical agents try to do, or financial advisors, when they're leveraging the cash value maximization play, is they'll say, hey, well, we're still going to be within legal limits. There has to be a specific death benefit along with the amount of dollars that you're placing in there, and that's known as the cash value corridor. So if you go and you have now a net amount at risk to the insurance company of $100,000, but you're still putting in $1,000 as this hypothetical example, well, that tells us is that less dollars are going to go to the cost of insurance and other expenses, and more is going to go to that cash value component. So the cash value is going to give you that tax-free growth potential, that tax-free income potential, and then understand that this death benefit could be completely tax-free as well, that you would be able to leverage that sort of policy. So we did, as with the Fosse Financial Group, we understand that the most important aspects of these policies are net amount at risk, the NAR. And when you control the NAR, that's how you're able to control and strip away these costs that much further regarding the death benefit, regarding the cost of insurance, other expenses. So when we set up our plans, we like it to look something like this, that thousands of dollars, that $1,000 going in there. Yes, we have the minimal death benefit that Internal Revenue codes allow us to have within that. It has to be compliant within that cash value corridor. But what we do is we fixate on that net amount at risk, and we say, okay, well, what are those risks to the insurance company that allows us to even further reduce that net amount, that cost of insurance and other expenses, and maximize that to cash value? So there's two parts to this. The first part is you want to, if you're looking for a true cash value maximization, the death benefit has to be the least of your concerns. Understand, I'm not talking about a life insurance policy specific for the death benefit. I'm talking about a cash value maximization plan. When you try to set that up, your death benefit has to be the bare bones minimum that the Internal Revenue Code allows you to put it at. So in this case, we understand it's $100,000. What you're probably asking yourself is, well, why is this slide showing a much greener component than the other slide that I just showed with this red over here? And the reason being is because we lowered the net amount at risk. We understand, and we found specific insurance companies that have patent pending designs on how this death benefit gets paid out. So rather than, if you have company A, that let's say they're just like every other company out there, they pay this death benefit out in the form of a lump sum. So that says this person puts a premium payment of $1,000 and then this individual passes away, $100,000 has to come off this company's books in the form of a lump sum. Well, you have other carriers out there that allow this death benefit to be annuitized, meaning that it could spread out up to a 30-year time frame with how that death benefit gets paid out. So like a really easy example is, let's say if this death benefit was $300,000 with company A, we understand that $300,000 would have to come off their books within that first day. If this person had company B and that person was to pass away, well, now the insurance company could pay $10,000 a year for the next 30 years and make sure that they're controlling their profits better. When the insurance companies have less net amount at risk, then they transfer that risk onto the insured, the individual that owns this policy. So if you're having a lower net amount at risk, there's less risk on their books, that type of policy is going to have much less cost of insurance and other expenses than a policy that has a lump sum death benefit. So understand that if you're looking to leverage this cash value maximization play, you're not concerned with that death benefit. Yes, the death benefit will always be there. Yes, that death benefit will be much higher than if you contribute to a 401k account or an IRA account. But the main purpose of this is to keep this policy or keep the maximization under the House of Life Insurance, stay in compliance with Internal Revenue Code 7702 and 72E to make sure that you could hoard as much dollars into this cash value as possible. So as I scale back to the very first slide, remember, with a regular permanent death benefit policy, the dollars are going in, majority is going to the cost of insurance and other expenses, and then a very small amount is going into that cash value. If we go in like a typical cash value maximization plan, all you do is just lower that death benefit to say that more of those dollars are going into more of the green of the cash value and less into that cost of insurance and other expenses. When we truly want to maximize that, we want to focus in on the NAR, the net amount at risk, and then this is when we set up, we have proprietary relationships with carriers out there that have patent pending designs on this death benefit, on how that death benefit gets paid out. Rather than in the form of a lump sum, it could get paid out up to a 30-year time frame to significantly reduce that risk to the insurance company, and therefore they significantly decrease their charges directly to the consumer, to the individual, the owner of the policy. So we just have a lower net amount of risk. Now understand that I said that there's two components with cash value maximization. The first one was what I just showed you on those 3 slides. We want to strip away those costs, reduce that net amount of risk as much as possible so that if you're putting in $1,000 as an example, well, we want to try to have $1,000 or $990 going into this bucket on one side. The other side is how exactly does this rate of return work? So you have some companies out there utilize, like whole life insurance, they utilize a fixed percentage rate, which is known as a dividend rate. You have universal life, which is tied to interest rates. This was very popular in the 1980s, which I completely go against. I do not think that this is a very good policy because obviously interest rates are at all-time lows. You have variable universal life, which says that this component could either be positive, this interest credit could be either be positive or it could be negative, and then you have a bunch of different mutual fund related expenses and different expenses that are, that could really dip into that cash value. Or else you have my recommended option, which is the IUL, the index universal life, which says that this interest credit could either be positive based upon a stock market index or it will be 0%. So this allows you to have really good double-digit returns, a lot of flexibility in there, much more flexible than the whole life insurance products. And when you're comparing an apples to apples, these would be my top 2 would be either a whole life maximization or an IUL. But the IUL, when you're comparing apples to apples and you're showing the illustrations and all those different things, the IUL should blow the doors off of the whole life insurance policy. So whether, I understand some agents are going to be, commenting and all that stuff, some whole life insurance agents, and that's completely fine. That's your own opinion. But I know if I go toe to toe with a whole life insurance policy, and that's something that I could also offer clients, I will not put them in a whole life insurance over an IUL if the IUL is going to be mathematically a lot more favorable for that position. So, that's kind of my 2 cents on it. That's kind of my argument behind it. And it allows us to open up the hood and really look at all the components, all those different negatives, all those different expenses. So you're able to see mathematically whether it makes a lot of sense to go into this cash value maximization plan. So usually when this works very beneficial is when an individual has a retirement plan through their employer and they're trying to hoard more dollars aside as a retirement supplement. So let's say if you have an individual that's in their 30s and their 40s, we'll just call age 40, and this person's making $100,000 in a given year and they're offered a 401k plan. If this person is being offered a 401k, and let's say that, and a 401k is a type of employer-sponsored retirement plan. It kind of works like a bucket that an individual could take a portion of their salary, place it into this retirement vehicle, and it's going to be the combination of the dollars that are going into this bucket plus whatever the interest credit that comes back returns to either make this bucket larger or smaller at the end of the day, the end of the year. If this 401k is maximized and they're putting a lot of contributions, and then you have a positive interest credit from the mutual funds that are chosen within that 401k, well, then you're going to have a larger bucket. If, let's say, like a 2008, if that mutual fund performance comes back negative, well, it didn't matter how many years you're placing aside those contributions. You could have an individual that walked into the year with 500,000 in their 401k, walk out of the year with 200,000 in their 401k, or 300,000 because of this negative component. So when we're trying to leverage a life insurance retirement plan as a supplement, what we want to figure out is with 401ks, usually they're offered something known as a match. So if this person's making $100,000 in a given year, and let's say they're putting in $10,000 into their 401k, but we understand that their 401k is only matching them 2%, that says that the employer is going to come to the table and put $2,000 of their own money to add into that bucket. So that match is free money. That match is great money. That's the amount of money that you should be placing into your 401k, is to at least incorporate what that match is. Because if this person puts in $10,000, but they're only getting a $2,000 match, well, then $12,000 is going into their bucket. If you have really cruddy mutual fund options or funding options, and this could come back negative or not have a favorable rate of return and not be tax favorable and all these different components, well, then you might be shooting yourself in the foot by really overfunding this 401k. Typically what makes the most sense, and only for an individual situation, if let's say this 40-year-old says I want to retire at age 65, what we do is we look underneath the hood and we say, okay, well, you're getting a 2% match. What happens if you were to put in $2,000 into your 401k, get the match of $2,000, so now you have $4,000 working in your 401k, set up good recommendations regarding how to really maximize out how that 401k platform works, and take a very scientific approach to run a bunch of analysis saying what is your current funding options that you're choosing, what is your allocations that you're choosing, what is the chances of success of that being really good or preventing a downward market disaster, honing in and making sure that you're at least being educated properly on how to maximize out that 401k. And the other dollars, if let's say your other $8,000 can be better suited to go into a maximized cash value life insurance retirement plan, maybe that makes more mathematical sense. And we try to look at a couple of different things. We try to look at taxation. We try to look at rates of return, of saying historically, how well has your 401k done versus historically how well has this cash value component done. We look at the prevention of downward market losses. IULs offer a 0% floor if the market goes down. 401k obviously doesn't have that. And then you also look at the expenses, and I think the expenses are probably the most important, is because obviously you don't want to place your dollars into a life insurance retirement plan if it's going to be more expensive for you in the short end than if you're looking to place that into a 401k with very light expenses, much higher rates of return. So it's really a case-by-case basis, but I just wanted you guys to understand the generic shell of what we're trying to do is strip away those costs, hone into the net amount at risk, and then show you that comparison and whether it makes sense to go and leverage a portion of your dollars into that max funded cash value plan, life insurance retirement plan, and while still staying consistent with your employer sponsored retirement plan. So, there's a couple of different moving parts, but we try to make sure that everything is segmented into a very concise, transparent approach. So I hope you found value in this video. If you have any further questions, if you want some help regarding, what might be your situation, you want to speak to a specialist, simply call our 1-800 number. It's 1-800-566-1002. We offer 24/7 customer service. We're available mornings, nights, weekends, holidays, whatever the case may be. And we're going to try to educate you first and foremost. We're A+ rated on the Better Business Bureau. It's because we try to educate through literature pieces, personalized videos, different things to help you get comfortable and really understand whether something, makes more sense to designate any dollar. Does it make more sense to designate that into a life insurance retirement plan? Does it make more sense to designate it into your employer-sponsored retirement plan or a Roth IRA or traditional IRA? What exactly is the best comparison tools out there? And we utilize a proprietary software known as a Retire Sharp planning system that shows us, it unveils underneath the hood upon all these different comparisons, all these different strategies, along with all these different accounts and products on which one makes the most mathematical sense. So I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thank you so much for watching, and we really look forward to speaking with you. Take care.